Okay, so quick disclaimers before I get to it. The results here are provided for general information purposes as a convenience to the viewers. Thank you, guys. Thanks, Danny. The materials are not substitute for obtaining professional advice from a qualified person, firm, or corporation. And as a reminder, please note that the executions and other statistics in this video are hypothetical and don't reflect the impact, if any, of certain market factors such as liquidity and slippage. Okay, so that was the disclaimer. So before I, just go, I usually have someone doing an intro for me, but I'll give an intro of myself, which feels weird, but I think it's necessary because, especially in finance, let's make sure that all of us, this goes for all of us, let's make sure we listen to people who at least have some experience. We don't just want to listen to the next guy on Twitter. So my name is Ophir Gottlieb. I'm the CEO of Capital Market Laboratories. The firm, CML, is a member of Thomson First Call. So all of our research sits next to JP Morgan, Goldman Sachs, Morgan Stanley. And our goal is pretty simple. It's to empower every trader to have the same tools and information available to them as the top 0.1%. All right. As for my background, I'm a former option market maker on NYC ARCA and CBOE, exchange floors. My background is in financial mathematics and machine learning, where I did my graduate work at Stanford University. And of course, right now I'm heading CML. I used to work on the institutional side as managing director of algorithmic trading for Livevol, which was purchased by CBOE recently. And then I moved on to be the managing director of quantitative research at GMI, which was actually just recently purchased by MSCI, which is one of the offshoots of Morgan Stanley. In that role, I created and ran our machine learning quant models, and in total, the clients that were subscribers to my models managed more than $1 trillion in assets, okay, including the entire state of California. By entire state, I mean CalPERS and CalSTRS, their pensions. And, we treated our institutional clients very well. This is just kind of me fessing up. So well that after the sale of the company, I realized that this information asymmetry, that is what the institutions know and what retail doesn't know, it was simply untenable for me. Left a really bad taste in my mouth. And that's why I created Capital Market Laboratories, and that's why we're the company we are today. It's why I've been doing presentations and webinars like this for the last 3 years, and that's just the truth. Okay. So that's the quick about me. Now we can get to the good stuff. I know bios are boring, as are disclaimers. So today I'm going to focus on what have been the 5 best option strategies in this market. But I want you to know that we have empirically and tested this data on 2007 through 2008, so the Great Recession, and it also worked during then. Okay, so I'm not just showing you strategies that work in a bull market. I'm trying to impart upon you a certain level of education as we all trade, and everyone can use education, including me. Okay. I do note that we have an options volatility class coming up in 4 days. I was going to charge $1,000 for that class. Instead, it's just free. I just want everyone to know what the institutions know, and that's how it is. So in that webinar, I will show empirically that what I'm showing you today, with explicit and objective results, that these strategies not only work during the raging bull market of the last 6 years, but also work during the heat of the Great Recession. Having said that, this presentation, since we're a little bit limited by time, I don't want to just run long, is going to be a little more succinct, which is good. It's an interesting watch. A lot of the really empirical, hardcore math behind it has been hidden just because it's just not necessary for this venue. Okay. And while the video will start with bullish directional momentum, that's just one part, and that this very specific type of implied volatility trading, which does happen to be bullish, did work during the Great Recession. I can only repeat that so many times. We will then look at some technical trading, both bullish and bearish setups. And the only technicals we ever look at are ones that, when empirically tested, work. Okay, so I'm not going to show you moving averages that haven't worked. I'm not going to show you models that haven't worked. I'm not saying that things don't work for you. I'm telling you that when we back tested over 10,000, 100,000, a million trades, we can see what has worked in the past and what has not. And that is what our company is about, right? So we are not advice. We're kind of the opposite of advice. A registered investment advisor, which is a great idea, you can have a registered investment advisor, they generally give you a forecast. It's their best guess, and sometimes that guess is very good. We're kind of the opposite of that. We're simply empirical. So we're fact-based. What I'm going to show you is empirically provable fact. That's it. I'm not here to give advice. I'm here to show you what has worked and what has not worked empirically. Okay. Finally, I'm going to review the two strongest non-directional trading strategies that have worked during this bull market and the last bear market. Okay, so we're going to go bullish directional, we're going to go technical, and then we're going to go non-directional. All 5 of those strategies have worked during the Great Recession and have worked during the bull market. Okay. After a review of these 5 strategies, we'll see that you can have a diversified portfolio for trades to choose from. So that is, you can accept the ride in the bullish trend, no problem, and others that are counter to the trend, and finally ones that have no directional positioning at all. Okay, so that's how you survive if we do go to a bear market. Now this one, I'm going to give you one piece of opinion. This is not empirical fact, this is opinion. In my opinion, the best way to survive a bear market is in options is to do a heavy study in implied volatility and then to be in the market in short bursts of time. I'm not one of those people that thinks you should be in a bear market for an extended period of time. It's short bursts of time throughout the bear, a week, 3 days, a week, 3 days. And I'm going to show you how that has worked empirically in the past. Okay. So that's the last bit of opinion you're going to hear on this webinar. The rest is just going to be fact. So I'm going to start with the pre-recorded video. And then I'll come back live. And I use a video just because if I were to present this live, it would take 3 hours, and in a video it's like 20 minutes. It's the magic of video editing and audio editing. So first thing I'm going to do is I'm going to play the video for about 5 seconds. Thanks, Danny. Yeah, we added some to it. So I'm going to play the video for about 5 seconds, and I'm going to stop. And I'm going to make sure everyone can hear it, because I don't want to play a video for myself. I want to play a video for you. So I'm going to push play. I'm going to stop in about 5 seconds, and I'm going to ask again, can everyone hear me? And if that's okay, then I'll let it rip. So I'm pushing play for 5 seconds. Here we go. Let's talk about answers. Does momentum trading actually work? I mean, we've all... All right, all good? Okay, so I'm doing this. I'm pointing my microphone at a speaker. So if you guys are saying, yes, I trust you, I'm just going to let it rip now. And I will be back, of course, live for Q&A. That's why this video isn't too long. It's because I didn't just want to show you a video and then walk away. So I'm here. And you can feel free to ask questions during the presentation. So here we go. I'm just going to start from the beginning. Here we go, guys. Let's talk about answers. Does momentum trading actually work? I mean, we've all had great momentum trades, and we've all lost on momentum trades. But empirically, does this work? And if so, when has been the best trade entry? Which stocks have worked the best? And what has been the best time to exit? What are realistic average returns? What are historical win rates? And if this strategy is more than simply a reflection of a bull market, it should have worked during the bear market as well, during 2007 and 2008 when the S&P 500 collapsed into the Great Recession. If momentum trading has worked in the past, it should be empirical and explicit. And that's it. Also, how about technical analysis or technical trading? Does it really work? It's all over social media and fintech news, and if it really does work, okay then. Which indicator has worked the best historically, on which stocks, at what times, when has been the best time to exit? Again, what are realistic average returns? What are historical win rates? It doesn't matter how much noise there is out there. If technical analysis works, the results should be empirical and explicit. That's it. And what about non-directional option trading? Has there been a way to profit from this low volatility world, this low VIX world, without making a directional bet, without betting on a bull market continuing, or even more abrupt if we go into a bear market or a correction? Again, empirically, does this work? And if so, when has been the best trade entry? Which stocks have worked the best? And what has been the best time to exit? What are realistic average returns? What are historical win rates? And again, if this goes beyond coincidence, beyond just a bull market, it should also work during a bear market at a time when volatility was elevated, like during the 2007-2008 market crash. Answers. That's what this is all about. We're going to cover all of this, and we're going to do it pretty quickly. We'll start with momentum, then technical analysis combined with momentum, then non-directional history. All right, let's go. We're going to start with momentum. We'll start with our first pre-earnings pattern. I call this a directional bet on optimism. So one of the least recognized recognized but most important phenomena surrounding this bull market is the amount of optimism that sets in the 2 weeks before earnings in the mega technology stocks. We're talking the FANG stocks. Now, this is totally irrespective of whether the stocks have a history of beating earnings. In fact, many of them don't. But in the 2 weeks before earnings, there is a massive momentum rally into the event. What the scanner will help us see later is that while there is this 2-week pattern, sometimes 1 week or even just 3 days presents a better trading window, both with respect to consistency of the win rate and, of course, total returns. We'll start with 2 weeks here and address the other time periods when we cover the scanner. Let's look at a simple idea. Let's just buy a monthly call option in Alphabet 2 weeks before earnings and selling the call before the earnings announcement. So we'll get long a call, we'll go to custom earnings handling, we'll open the trade 14 days before earnings, and we will close the trade 1 day before earnings. We are not taking an earnings bet. This is a pre-earnings trade. And here are the results. We can see across the board this has been a winner. And just to see what's happening, we can look at the stock price. This is a 2-year stock chart of Alphabet, where the blue E icons represent the earnings. What's so interesting here is that while the stock almost always rallies before earnings, you can see that with these little yellow arrows into the earnings. The stock goes down off of earnings a lot. In fact, that's what these yellow rectangles are. This is how many times Alphabet missed earnings. It's just a coin flip, but it never interferes with this optimism, this bullish momentum. While we're looking at this, we might as well look at the rest of FANG. So I'm just going to put the rest of the tickers in here, comma delimited. As I said, this works with all of the mega tech stocks, but what we need to do to find the best trades is to focus on the win rates. Netflix and Amazon are a coin flip. Even though the returns are positive, these aren't the best of breed. But a good trade turns into a great trade only after we do risk control. So let's drop a tight stop on these calls and also a tight limit. We'll go down to the close trade when section. We will close these long calls if they go up by 30% in a 2-week period, and we'll also close them if they go down by 30% in a 2-week period. All of a sudden, the trade is clearly in Alphabet and Facebook, not Apple, Netflix, or Amazon. So let's focus on those two. Now we can see the staggering returns, and we can see 15 wins on 1 loss if we held these 2 as a portfolio. And just so you know, we're not pulling a fast one on you, and that calls always work on these companies, we can just look at the 15 days after earnings. So we'll open 1 day after earnings and close 15 days after earnings. These trades are actually negative. So this is in fact a pre-earnings momentum trade based on the personality of this bull market. While we're here, let's go ahead and look at another trade that's very similar. We'll go to custom earnings, and this time we're going to look to open the trade just 1 week before earnings, so 7 days before earnings and closing it the day before, as opposed to the 2 weeks before earnings trades we looked at with Google and Facebook. And this time we'll look at NVIDIA. So we're going to buy a call 7 days before earnings, close it the day before earnings, we'll put a stop and a limit, and we'll look at the last 3 years. And here we can see with NVIDIA 11 wins and 1 loss with a 1,352 total return. And if you're wondering how I knew to look at NVIDIA a week before earnings, this is how. We're going to introduce the Pro Scanner, which is available to Trade Machine Pro members. We select Pro Scan, then we select By Strategy. We can choose any grouping of stocks, but for now, we'll use the S&P 500. Since we're looking at pre-earnings momentum trades, we're going to scroll down to the pre-earnings section. You'll note that we scan for 14-day, 7-day, and 3-day pre-earnings momentum trades. We'll select the 14-day since that's what we're looking at with Google. The scanner automatically sorts the results by win rate, and since the 14-day scan does not use a stop or limit, the highest win rate in this group of tickers is actually the tech gem Akamai, with 10 wins out of the last 11 earnings sessions for a 91% win rate. We can see a 38% average return per trade, and that includes the 1 loss. That's over 38% for just 14 days. The total backtest return is 426%. Finally, we can see Google, and here are the results before we put in the stop or the limit. We can also sort our results by the total backtest return. So this is for the trader that's comfortable with the backtest that has shown a lower win rate but larger returns. Let's now look at the 1-week backtests and just look at the 3-year results. So we'll tap on 7 days and we'll deactivate the other buttons. We can see NVIDIA here. This is a tech darling that has had immense pre-earnings momentum, showing 11 wins out of the last 12 pre-earnings sessions with an average return of 39% in a week or 493%. For those of us that like trading the tech names, we can select the NASDAQ 100 and sharpen our scan results. We can find a familiar name as well, which is Microsoft at the top of the list, which has won for 3 years in a row the 1 week before earnings, showing an average trade return of 50% per week. Microsoft is one of those curiously forgotten tech names. Let's let the rest of the world forget about Microsoft. We will not. Now, this 7-day pre-earnings backtest and the 3-day earnings backtest, which is really just a tight swing trade, do in fact implement a stop and limit of 40%. This is our first exposure to the Trade Machine Pro scanner, and all we have done so far is just look at a very small subset of another subset, which are pre-earning scans, the momentum pattern. And it's a fair question to ask if these returns are simply a reflection of a bull market rather than successful strategy. But it turns out this phenomenon of pre-earnings optimism also worked very well during the 2007-2008 Great Recession, when the S&P 500 collapsed. Using the NASDAQ 100 and Dow 30 as our study group, we saw, by stock, a 45.3% average return over those 2 years. And of course, those are just 8 trades per stock, each lasting only 7 days. Yes, this is empirical. But this leads us to one of the other benefits of the Pro Scanner. We can simply click on a ticker and it will load the backtest in our trade machine for us. So let's click on Microsoft, and here are our Microsoft results. 12 wins, no losses. And down here is where the limit gain and the stop loss have already been implemented. We can click on custom strategies and we'll see we are looking at, in fact, this 1-week trade. So we finished step 1. We found answers for momentum trading. Yes, it does work. The trade entry can be 3 days, 7 days, maybe even 14 days before earnings. The scanner shows us which securities have worked the best in the past. It shows us when to exit using the stop loss and the limit gain. It shows us what the historical returns are. It shows us what the historical win rates are. So has momentum trading worked? Yes, it has. Now let's turn to technical trading. While there are hundreds, if not thousands, of technical indicators, in the trade machine we focus on very few. Right now we're going to focus on what has been called the TTM squeeze, first discovered by famed trader John Carter. This signal is actually a combination of 3 technical indicators to make a single signal, and that signal can either be bullish or it can be bearish. Now, it's always important to understand precisely what a trade is doing. So to understand this signal, we have written a full-blown dossier with the videos. You get to the dossiers by going to the Discover tab, and then looking under FAQ, you can go to Technicals in the TTM Squeeze, and when you tap on that link, you get a full-blown explanation of how this works. So not to run too long, we're going to skip a description, but remember, the details are available through the Discover tab, and there is never an excuse to trade without understanding the facility behind it. And while this might sound complex as we've introduced it, like most technical trading, it really isn't. It's very clever, it's very useful, and it's also very easy to understand. So now we will look at technical trading with options, and we won't pay attention to earnings at all. The idea behind the squeeze is that for the vast majority of the time, stocks tend to move pretty quietly sideways. Then they move abruptly either up or down, and we're not talking about those big earnings moves. That is, we're here to answer the question we posed at the top of this video. Does technical analysis work? Here we go. So we'll enter our tickers. We'll look at 5 of them. We'll look at getting long a call spread, never trading earnings, and doing it during the bull squeeze. We'll set our days to expiration to 15, so we're going to be looking at about 2-week options. Then we're going to go to settings, and we're going to go ahead and put it 5 years back in history. And here are the results. We can see in the 3 mega cap tech names, we got Facebook, Amazon, and Alibaba. We're looking at high win rates and large returns. Then we look at another momentum tech name, Activision, which has 10 wins and 1 loss. And then we just look at another momentum name, which isn't a tech stock, and this is just Domino's Pizza, which has seen 12 wins and no losses for a 423% return over the last 5 years. We can just tap on a backtest tile. We can see the total return. We can see the average return. We can see the number of wins and losses. We can see what the stock has done over the last 5 years and how this strategy is done. Another thing to note, if we look at Amazon, for example, over 5 years, this trigger only fired 11 times. And it turns out that over the last 5 years, that's 1,824 days, this signal was live for only 144 days, so less than 8% of the time. This is a signal which doesn't happen very often, but when it does, it tends to carry a very strong indicator. While we have done the empirical analysis, and the TTM squeeze technical indicator is in fact statistically significantly better than just buying a call spread, which is to say, this isn't just happening because there's a bull market. It's fair to ask, does this indicator work during a bull market trying to find bearish indicators? And the answer is, yes, it can. We can now do the same thing, but with a bear squeeze. So we'll enter our tickers, we'll go to a put spread, we'll go to never trade earnings, and we'll look at the bear squeeze. And for this, we will add 40% limits and 40% gains, and we'll look at the 30-day options. In this case, we're looking at a large cap tech stock, a European bank, 2 retailers, that's Kohl's and Kroger, and 1 industrial with Federal Express. And again, we can see when you pick the right companies, you've got high win rates and large returns. The second technical indicator we looked at is the CML Mammoth. That's for moving average and momentum model. And here's how it works. We started with several moving averages. Then we took them and we lined them up relative to where they were for each other. That is, which ones were above the others and which ones were below the others, testing all of the various combinations. We also tested how far apart the moving averages were from each other. That is, were they really spread out or were they tightly grouped together? Then with some machine learning techniques, we found the comparisons and the moving averages that helped predict future stock returns. The next step was to include the current stock price in this measurement, where it lined up relative to the moving averages, and how far it was from them. Once we had a definitive solution for that, we turned to momentum. We didn't only look if a stock had moved up or down on consecutive days, but also by how much. Was it a small move up or a large move up? Or a small move down or a large move down? Finally, we looked at the Bollinger Bands and the Keltner channels, and if the stock was above or below the key levels. With all of that, we were able to build the CML Moving Average Momentum Indicator, CML Mammoth, an empirical and explicitly tested technical indicator. We have the full details of how this technical indicator was created, including the full equation that allows you to calculate it yourself in the Discover tab with great detail. Now let's look at some of the results. We'll start out by entering 4 tickers. We'll do 2 of the chip giants, NVIDIA and Lam Research. We'll do everyone's favorite momentum stock, Netflix. And then just for a change of pace, we'll look at Ford Motors, the automobile manufacturer. We'll look at getting long a call, never trading earnings, and we will use the Bull Mammoth technical indicator. And here are our results. Over the last 5 years, using the options that are the closest to 14 days. You can see across the board the results are enormous, and we can see the win rates. With NVIDIA, we're looking at a 60% win rate, so this trade certainly does lose. With Lam Research, we're looking at a win rate of 65%. With Netflix, we're actually looking at a win rate of 53.5%, so 23 wins and 20 losses. And with Ford, over 5 years, even though this only triggered 7 times, it did in fact win all 7 times. But the key to notice here is that this trade doesn't occur a lot. It does occur more frequently with stocks that are more volatile. So we can see that technology stocks have more trades triggered than Ford over the last 5 years. But let's dive deeper. If we tap on a backtest tile, we can see the details. So for NVIDIA, we can see the average return was 40.8%, 21 wins and 14 losses. So an average return of 40% over 35 trades every 2 weeks. The average win was over 114%, and the average loss was 69%. So when this trade goes bad, it certainly is a substantial loser. But the trades win more often than they lose, and when the trades win, they're substantially larger, almost 2 to 1, than the losses. We can take a look at Ford, a less volatile stock. We can see the average trade return, again, this is over 14 days, is 65.5%, with 7 wins and no losses. However, over 5 years, this only occurred 7 times, so it's a trade that requires patience. As always, to learn more about the model, you can just go to the Discover tab, and underneath Frequently Asked Questions, you can go to the details behind the CML Mammoth model. Tap on that link, and here you will see a full description of the model, how to use it, the general idea behind it, and then step by step, variable by variable, the statistical results, the significance, and all of the details that allow you to recreate this model yourself if you want to. So that's it. We wanted answers to these questions. Does technical trading actually work? What is the signal for trade entry? It's the bull or bear squeeze, or the bull or bear mammoth models. And where do we find discovery of the companies or ETFs where this has worked the best in the past? As always, it goes back to the Pro Scanner. And now we have completed step 2. We have with great specificity questioned, tested, and discovered the results of patterned pre-earnings momentum and technical momentum irrespective of earnings. Our final task now is to answer, what about non-directional option trading? And here we go. It's long been believed and proven that simply owning an at-the-money straddle in most stocks is a loser. In fact, we can do it with our backtester looking at Google. Here it is, getting long a straddle, doing nothing with earnings over the last 3 years, buying the 30-day option. This trade has only a 41% win rate and is down 57% over the last 3 years. But we started this discussion with a question, which is, what about non-directional option trading? Is there a way to profit from it without betting on a bull market continuing, or even more abruptly, even if we go into a bear market or correction? And we want empirical results. Does this work? And if so, when has been the best trade entry? Which stocks have worked the best? What has been the best time to exit? Since we see normally owning a straddle in Google has been a loser, let's try something different. We'll come down to custom earnings. And now we'll look at opening the trade 1 day after earnings and closing it the week after earnings. That is, it's a 1-week trade right after earnings. So the stock does its gymnastics after earnings. We wait a full day, then we buy a straddle with the 30-day options. And here are those results. Over the last 11 earning periods, it has won 9 times and only lost twice, with a 263% total return. Remember, when we did this without using custom earnings dating, it was a 57.5% loser. We can find dozens, if not hundreds, of these opportunities where owning volatility looks like a loser and the market believes it to be a loser. But timing it correctly around earnings has proven to be a gigantic winner. And the answer, of course, whether it's before earnings or after earnings, is in the Pro Scanner. So we go back to the Pro Scanner, we go by strategy, we pick our ticker group. In this case, we'll just look at the S&P 500. We have the 7 days post-earnings long straddle, which we looked at with Google, or if we prefer, we can look at 7 days pre-earnings, or even 14 days pre-earnings. So these 3 scans find us the companies where owning volatility, even in this low VIX world, has been a winner. So we can answer empirically. We do know the best trade entry. We do know which stocks have worked the best, and we do know the best time to exit by using our stops and limits. We started this discussion saying we wanted answers to 3 questions. Has momentum trading actually worked? Has technical analysis actually worked? Has non-directional option trading actually worked? And if so, we should have empirical and explicit answers for each of those. We've answered our questions, and we have been empirical, and we have been explicit. There are other questions that the trade machine can answer, like, has non-directional option trading while selling options worked? And if so, when? And in which securities? And what are the historical win rates? The trade machine was built to answer questions for traders. It was built to be empirical. It was built to be explicit. And of course, it was built to be easy to use. There's so much more the scanner has, including custom portfolio building. But for now, we have succeeded in our goal. We have answered our questions, and we hope you are a more powerful trader for watching. Thank you for your time. Now, of course, we just focused on earnings-related trades. If you like trading the actual event, we have a button for that. You can just click Only Trade Earnings and test any strategy you want, whether it be custom or pre-built during the earnings event. And of course, for all other times, you can always just select Never Trade Earnings, and you can do the same thing. You can create your own custom strategy or pre-built strategies. And finally, it bears repeating, while we just looked at the FANG stocks, we cover every stock and every ETF and every index in North America as well. The opportunities are there. You just need to find them. So this is it. This is how people profit from the option market. It's preparation, not luck. Thanks for watching. Okay, I'm going to plug in my headphones, so hold on 1 second. All right. Get off the screen. Can everyone hear me pretty clearly? Cool. Thanks, Marlon. Thanks. All right, guys. I'm here to answer questions. Just one thing for this open house, um, Danny and I, MrTopStep and I have teamed up, and we're offering Trade Machine for a 40% discount. So it's normally $129 a month, and through this link, cmlviz.com/mts, MrTopStep, it's $79 a month. This is a month-to-month software, so if you don't like it at any point, you just stop it, cancel it, and the first month, if you don't like it after a month, you just tell us. We'll just send you a refund, and don't worry about it. We're not really interested in having people use software that doesn't help them. Having said that, our retention rate is extraordinarily high. So yeah, I see that John shared um, the link in the chat, and I'll do so also. These look like different links. It's just they lead to the same place. We just have a cool naming mechanism on ours. It's all the same. This Saturday, February 24th, I'm doing a volatility webinar, which is headier. It gets into the same strategies, some new strategies, also alerts. So you say, hey, I like this strategy. Can I get an alert 7 days before earnings? Show you how to set up alerts. But it also kind of gives you the educational background behind why such a thing would work. So empirical results are great, but really, if we're going to be scientists, we have to know why it's working. Otherwise, it's just kind of flipping a coin. So just wanted you guys to know that. That is the end of my formal presentation. The trade machine can do a lot more. I just don't think that it's in everyone's best interest to just sort of like force you to see every single feature and benefit in the application. The Pro Scanner, the Back Tester, the Discover tab, the Alert tab, this allows you to be a trader, whether you're kind of day to day, or if you're just kind of doing your normal work and you want to get alerts when things are going on. We have that as well. So I really encourage you to try it out. If you don't like it after the first month, if you don't like it after the first day, just tell us and we'll just send you your money back. It's really not about trying to keep the first month of $79. We have people who've been with us for years, and it has helped them trade. And one thing to note though, at some point we're going to go back to the $129 a month. If you sign up for $79 a month, your price will never go up. But at some point, this promotion will end. It will be $129 a month, and we get lots of people emailing us when promotions end saying, hey, I saw your webinar and I was hoping I could get the price. We just don't do that. It's just not fair to the rest of our users who did subscribe for a discount. So when the discount's over, it's over, and just don't even bother asking. So if there are any questions, you can feel free to ask in the chat window. Otherwise, I'm going to leave the room a little bit early. I don't want to overstay my welcome. I want to thank Danny, Bob, John, and Marlon. Thank you so much for allowing me the opportunity to present, and thank you so much to everyone who is watching for the opportunity to present software that is powering institutions, and it's about time that it powered retail traders as well, in my opinion. Okay, so I see no questions, so I'm gonna go ahead. Thanks, Jars. Thank you very much, guys. Thank you so much. I'm gonna head on out. Enjoy the rest of the open house. I know that MrTopStep's gonna have a phenomenal group of people, and I hope I at least am average, because I know this is a pretty great group. So thank you so much for your time. Feel free to check out the sign-up page. You can see some more videos and stuff. And hey, may we all have successful 2018s, both personally and in trading. So thanks so much, guys.